Welcome to Breaking News to Trading Moves. I mean, think about it like this. When you operate heavy industrial machinery, your hand is basically always hovering near the emergency stop button, right?
Yeah, absolutely. You're watching it the whole time.
Exactly. You watch the operation closely. The exact moment a gear slips or, the machine behaves erratically, you press that button. The system halts, the feedback loop is immediate.
Right, because you are physically present. You're watching the materials process, and you have, total agency to intervene the exact second reality deviates from your expectations. You're in control of the failure state.
But now imagine turning that machinery on, locking the factory doors, and just walking away for 14 hours, letting it run entirely on its own in a dark room.
You completely surrender your ability to defend the operation. I mean, if a part breaks, the machine just tears itself apart until morning.
Yeah, and that exact comparison surfaces constantly when market participants discuss holding a trading position overnight. The closing bell rings at 4 p.m., the exchange shuts down, and, you go to sleep.
And the market doesn't.
Right. Global events, central bank decisions, international news, they all continue to alter the valuation of your assets in real time. So today, we are exploring the calculation of risk when holding positions past the closing bell.
It's a critical discussion.
It really is. We need to answer a very specific question today. Does the closing bell inherently dictate unmanageable risk? Or do proper position sizing and rigorous trade planning render overnight holds a totally viable strategy?
And we definitely come at this from different angles.
We do. I take the position that holding overnight is an entirely manageable and, frankly, often necessary strategy. Time is the required ingredient that allows strong setups to develop, provided your exposure is calibrated correctly before the bell rings.
Right, whereas I approach this from the opposite direction. I view overnight exposure as presenting uniquely unmanageable risks. The danger is categorical because the risk is discontinuous.
Discontinuous.
Yeah, discontinuous. When you hold past the close, you face price gaps and breaking headlines while you are literally asleep. That structural reality just neutralizes your ability to react or, execute an exit when conditions change.
See, the problem with that strict intraday approach is this pervasive belief that risk somehow just disappears the moment you flatten your portfolio before 4 p.m.
It removes the overnight variable.
But it doesn't disappear, it just changes form. When you operate under a rigid rule that every single trade has to be closed before the final bell, you introduce a whole host of entirely new behavioral and mathematical hazards.
Like what exactly?
Well, you start forcing trades into a single time window, and that inevitably leads to premature exits. You find yourself overtrading, jumping into weaker intraday setups just to realize a quick profit before the clock runs out.
Sure, but...
And we know that multi-day momentum, breakout continuation, broad sector rotation, they don't operate on a 9-to-4 schedule. They require days, sometimes weeks, to attract institutional volume and mature. When you categorically refuse to hold overnight, you starve your best ideas of the time they need to work.
I understand the desire to let a macro thesis play out. Really, I do. But overnight risk is not just another standard variable you can smoothly model into a spreadsheet. It breaks the mechanical foundation of risk management.
How so?
Because during regular trading hours, price action is continuous. If an equity drops, it trades through the pricing increments, right? $50, $49, $48. You can execute a stop-loss order at $49. You have a defense.
Okay, sure.
But an overnight gap means the market simply opens away from the previous close. It closes at 50 and opens the next morning at 35. You never even had the opportunity to sell at 49.
Right.
You are left completely defenseless against unexpected headlines or macroeconomic shocks occurring in foreign markets. The continuous market becomes a discontinuous jump, and that jump bypasses every defense mechanism you built into your trade plan.
Wait, hold on. Let's pause right there.
Okay.
You're focusing heavily on the mechanical inability to execute a stop loss, but I want to make sure the mechanics of that are entirely clear to everyone. Walk me through the actual process.
Sure.
If I have a hard stop loss set with my broker at $49, explain mechanically why I do not get that exact price if the stock opens at $35. What is the exchange actually doing in those final seconds before the bell rings at 9:30 a.m.?
Right, so it comes down to the mechanics of the opening auction. Between 4 p.m. and 9:30 a.m. the next day, information continues to flow. Let's say a major geopolitical event occurs at 2 a.m.
Okay.
Buyers vanish, institutional sellers panic. They start entering market on open orders, or MOO orders, to dump their shares at whatever price the market will give them right at 9:30 a.m.
So the order book becomes completely skewed.
Exactly. You have a massive imbalance. The exchange's matching algorithm has to find a single price that clears the maximum number of shares to resolve that imbalance between buyers and sellers. It calculates what is called the indicative match price.
Right, to find the equilibrium.
Yeah. If there are 1,000,000 shares to sell and only 10,000 shares to buy at the previous close of $50, the algorithm keeps dropping the theoretical opening price until it finds enough buyers willing to step in and take on that risk.
It has to incentivize the buyers.
Precisely. It might have to drop the price all the way to $35 to find that equilibrium. So your stop-loss order at 49, it just sits on the broker's server overnight.
And then at the open?
When the market opens at 35, your $49 stop is immediately triggered because the current price is below your threshold. It becomes a market order, but because the price is already 35, you get filled at 35. You take a $15 loss on a trade where you plan to risk $1.
I see exactly how that auction clears. The algorithm prioritizes volume over your specific price target. But let's look at the alternative defense mechanism here. By mandating an arbitrary end-of-day exit, you are essentially applying an incredibly tight, time-based stop-loss to your portfolio.
I wouldn't call it arbitrary.
But it is, and we know the exact mathematical outcome of using an overly tight stop-loss. You guarantee that you get shaken out by normal market noise rather than an actual failure of the setup.
Cutting a position at the end of the day is not the same as getting stopped out by noise. It is an active, conscious decision to remove exposure.
It functions exactly the same mathematically, though. I mean, forcing trades into a single day causes you to interact with the most hostile flow in the market. The intraday environment is totally dominated by algorithmic trading systems designed specifically to hunt liquidity.
Well, sure, algorithms are a factor.
A huge factor. High-frequency algorithms will deliberately spoof the order book to drive the price down, trigger retail stop losses, absorb those shares, and then just reverse the trend. You manage your risk perfectly intraday, get stopped out by an algorithm for 50 cents, and then watch the equity rally $5 without you.
That happens, yes. Arbitrary daily exits subject you to that exact same friction. You close at the bell, paying the bid-ask spread, the setup remains perfectly valid, and the next morning the stock opens higher and trends without you. You trade the visible risk of a morning gap for the hidden, creeping risk of constant, planned intraday losses and missed opportunities.
But that misses the magnitude of the events we are talking about here. Yes, an arbitrary daily exit might cause you to miss a continuation. That's a bummer, but it protects you from catastrophic portfolio damage.
Is it really catastrophic if you plan for it? It can be. Look, while intraday risks certainly exist, sudden reversals happen, breaking news hits the tape at noon, your capacity to manage it in real time is the defining difference.
You can react.
Exactly. If a headline crosses the wire at 1 p.m., algorithmic trading might cause a sudden spike, but there is still a continuous matching of buyers and sellers. You can hit the bid. You can get out.
True.
When a headline hits at 2 a.m., there is no bid. The market is closed. By the time the opening bell rings, the asset has already been repriced by institutional participants in the pre-market. The physical inability to act means your risk model is suspended. You are no longer trading. You're just hoping the opening print is merciful.
And that mechanical reality of the opening print is precisely why position sizing is the mathematical defense. Since we know the opening cross can jump the price and, bypass a traditional stop loss, the defense isn't to run away from the overnight session entirely.
Then what is it?
The defense is to adjust the initial capital allocation. The clock is only one part of the equation. If a trader looks at a setup and asks, what is a realistic worst-case gap against me based on historical volatility and average true range? And they size the position so that an abnormal move creates only an acceptable loss for the total account, the risk is contained before the market ever closes.
Assuming the math holds.
Right. The danger isn't the clock itself. Carrying a fully leveraged intraday-sized position into an overnight environment, well, that is the danger.
But that sizing argument completely falls apart when you look at the reality of unprecedented shocks. You are relying on the assumption that a trader can accurately predict a realistic worst-case gap based on historical data. Historical models fail exactly when you need them most.
Oh, I disagree. We have decades of historical data for asset behavior. We know a mature, large-cap tech equity rarely moves more than a few percentage points overnight unless there is a specific, scheduled catalyst.
Really? Look at Meta a few years ago. Look at Netflix during their subscriber growth slowdowns.
Okay, earnings are a different beast.
But these are massive, highly liquid mega-cap companies. Historically, they moved maybe 4 or 5% on a volatile day. Suddenly, they dropped 25% in a single opening print after an earnings shock.
Right, earnings shocks.
A trader looking at historical volatility would have sized their position assuming a 5% gap risk. When the asset gaps 25%, your mathematical model shatters. Furthermore, this sizing argument completely ignores the mechanics of market liquidity in thinly traded assets.
Wait, you're combining two entirely different environments there. Trading liquid large caps and illiquid small caps require totally different sizing models.
The mechanism is exactly the same, it's just amplified by the lack of volume. Let's examine a small-cap biotech equity after a negative overnight catalyst, like, say, a failed drug trial.
Okay, brutal scenario.
It is. The order book at 9:30 a.m. is entirely one-sided. Market makers face a massive imbalance of sell orders and zero buyers. To find that equilibrium price we talked about, the stock has to open drastically lower.
Which is why you size down.
But even if you sized your position down to what you thought was a conservative level, the slippage on your exit can destroy months of progress. A theoretical 10% expected gap becomes a 60% execution loss because there is simply no liquidity to absorb your market on open order. A small position still causes immense damage when the execution price falls entirely outside historical norms.
Okay, liquidity is absolutely a crucial filter. I will readily agree that you cannot apply overnight sizing models to thinly traded penny stocks, low float small caps, or, assets that trade less than 1 million shares a day. Holding those illiquid assets overnight breaks the math.
It absolutely does.
But we are talking about a strategic logic applied to liquid markets. If you trade high-volume equities, the opening auction mechanism is actually designed to handle imbalances efficiently. The slippage exists, sure, but it is measurable and can be factored into the initial sizing model.
You still have to endure the gap, though.
Yes, but think about the math of expectancy here. If you manage a $100,000 portfolio and your strict risk limit is 1% per trade, that's $1,000 of risk, right?
Tracking with you?
If your data suggests the potential 20% gap, you only take a $5,000 position size. If the unimaginable happens and the stock drops 40%, which is double your worst-case estimate, you lose $2,000.
Which is 2%.
Exactly. 2% of your total account. It hurts, but it's not a catastrophic, career-ending loss. You neutralize the gap through allocation. And in exchange for accepting that strictly contained risk, you gain exposure to trends that require several sessions to develop.
Breakouts. Breakouts need time to clear resistance levels. Sector rotation takes days to play out. You allow the trade the breathing room it requires to capture the bulk of the move, rather than just scalping fractions of a percent intraday and constantly paying transaction friction.
Well, on paper, yes. If human beings executed math flawlessly and lacked emotions, your model works. But humans are executing these trades. And this brings us to the psychology of the trade. I argue that the psychological vulnerabilities exposed by overnight holds frequently override the mathematical safeguards you just outlined.
How so? I mean, if the math is set before the bell rings and the position is properly sized, psychology shouldn't factor into the opening print. The math dictates the outcome.
Because the decision to hold overnight frequently mutates into a hope-based rescue attempt rather than a planned strategy. A trader enters an intraday position with a full size expecting a quick move. The trade goes against them near the close. Instead of taking the planned intraday loss and closing the position, they refuse to accept defeat.
The classic hold and hope.
Yes. They hold past the bell, completely abandoning their original intraday sizing parameters, and they hope the morning gap will bail them out. They drag a compromised thesis into that dark room.
Okay, but that is a discipline issue, not an issue with the concept of the overnight hold itself. A failure of discipline will destroy a trader in any time frame, intraday or otherwise. If someone sizes a position for a 5-minute trade and holds it for 3 days hoping to break even, the failure is their adherence to the plan, not the market hours.
True, but it is a discipline issue uniquely magnified by the overnight session. Because the market is closed, you can't act, so you hope. Additionally, we have to look at event exposure.
Okay, let's talk about events.
Holding through scheduled binary events, earnings announcements, regulatory decisions, court rulings, or clinical trial results, that creates unusually high uncertainty.
Very high.
These events invalidate standard risk models because the outcome is purely binary. The stock will gap up 30% or gap down 30% based on a single piece of sealed information. The implied volatility gets crushed the moment the news is out. That's not strategic exposure. That's rolling the dice while the exchange is closed.
Right.
Options market makers price in these expected moves, and holding common stock through that event exposes you to the exact same volatility without the defined risk of an option contract.
You know what? That is a highly valid critique, and I concede the point regarding binary events entirely. Holding through scheduled major binary events is inappropriate.
It's just gambling.
It is. It falls completely outside the bounds of logical overnight positioning. If a company is releasing earnings or awaiting an FDA decision on a drug, the uncertainty is too concentrated. The original technical or fundamental thesis of the trade is hijacked by a single coin flip. However, my defense is not about unlimited, indiscriminate overnight exposure.
Okay, fair.
It is a defense of planned, calculated exposure. We must separate reckless, hope-based holds from disciplined, strategic holds. When you eliminate the binary event risk and you eliminate the poor liquidity, what remains is a carefully selected trade.
But even when you strip away the scheduled binary events, the market itself is a continuous generator of unexpected events. You can filter out earnings, you can filter out clinical trials, you can't filter out macroeconomic surprises. Well, consumer price index data often drops at 8:30 a.m. before the market opens. Sudden geopolitical conflicts, currency interventions, central bank announcements, these occur globally while domestic markets are closed.
Sure. But you avoid holding into scheduled macro data releases like CPI exactly the same way you avoid earnings. You check the calendar. Regarding the truly unexpected geopolitical events, that structural hazard is precisely why the selection criteria and the position sizing must be so rigorous.
It has to be perfect.
It has to be strict, yes. But let's evaluate the alternative structural hazard one more time. If you mandate that all risk must be extinguished by the closing bell, you force yourself into a highly compressed time window. You compete directly against algorithmic trading and high-frequency systems in an intraday environment where noise constantly dominates the signal. By stepping back, sizing down, and expanding your time horizon to include overnight holds, you elevate your strategy above that intraday noise.
You reduce your interactions with intraday algorithms, certainly.
Exactly. You are trading the actual technical momentum of the asset rather than the daily friction of market participants entering and exiting. Holding that carefully selected trade at the correct size provides tangible psychological benefits too.
Like less screen time?
Yes, drastically less screen time. It lowers the emotional urge to overtrade because you aren't forced to constantly scan for new intraday setups to make your daily quota. You do the research, set your parameters, size it correctly, and let the market work. The market doesn't become a toxic environment simply because a position remains open after 4 p.m.
It just becomes uncontrollable.
Uncontrollable, but manageable. The toxicity comes from poor planning, oversized allocations, and weak decision-making. When those factors are managed, time becomes an asset rather than a liability.
It is a trade-off. You exchange the visible, immediate danger of intraday volatility for the delayed, discontinuous danger of the morning gap. I maintain that the latter requires a much higher standard of preparation precisely because you can't defend yourself in real time. The discontinuity of the opening print is a structural hazard that can't be fully sanitized by position sizing. If the original reason for entering the trade intraday starts to weaken even slightly before the close, the position must be cut.
Oh, we completely agree there.
You cannot carry a compromised thesis into the overnight session hoping for a reset. If the setup breaks at 3:55 p.m., you close it.
And you definitely cannot carry a full intraday size position into a 9:30 a.m. liquidity vacuum. The inability to physically react to new information while the market is closed means your standard defensive tools are entirely disabled. You're left totally exposed to unpredictable opening prices.
I think we have a clear understanding of where our philosophies diverge, but also, where they align. We completely agree that no market participant should ever hold a position overnight when a major binary event like earnings or regulatory news is approaching. The implied volatility and the gap risk are simply too high.
Right. And we also agree that poor liquidity eliminates the viability of an overnight hold due to the severe slippage at the open. If the asset can't absorb the volume, the execution loss will always exceed the mathematical model.
And most importantly, carrying a position overnight simply because you're losing money and hoping for a morning reversal is an absolute failure of methodology.
The decision to hold must come from the structural setup of the trade, never from emotional attachment or a reluctance to realize a loss. You have to respect the mechanics of the gap.
Absolutely. As we wrap up today's discussion, it is worth reflecting on the value of viewing market exposure through these multiple lenses. We constantly have to weigh the highly visible, dramatic danger of an overnight gap against the often hidden, corrosive dangers of rushed, hyperactive intraday trading. There is always more to explore when it comes to the mechanics of market microstructure and portfolio exposure.
Definitely.
Think back to that heavy machinery running in the dark. Perhaps the solution isn't to frantically keep our hand hovering over the emergency stop button all day, but rather to design the machine's parameters so strictly that it can safely run a few hours on its own. It's a calculation every market participant must resolve for themselves.